This week, we're tackling rentvesting through a finance lens, specifically what sort of long-term planning you'll need to do before choosing to rentvest so that you don't blow your chance of ever owning a home to live in.
Welcome to Your First Home Buyer Guide, the podcast for first home buyers who want to move it along and become homeowners. But most importantly, it is for you to become an educated home buyer.
I'm Megan and that was Veronica. We're both buyer's agents and probably old enough to be your mum. But it's a good thing because between us we've got over 45 years experience to share with you and bucket loads of stories about avoidable mistakes. Together, we're going to make sure you get unbiased and real information you can rely on. Allow us to guide you on your home buying journey. We want you to become an educated home buyer so that you can stop looking for your first home and actually become a proud homeowner.
We've got loads of great tips for you in this episode, and if you'd like more useful tools, head over to the website homebuyeracademy.com.au, and there you'll get access to our free mini course, How to Price a Property Like a Professional. You will also find the holy grail of home buying education, Your First Home Buyer Guide, the online course for people who want to become educated home buyers. We created this for you to help you get on the right path to home ownership for your first home and beyond.
But before we get into the interesting stuff in this week's episode, we've got the boring bit, the disclaimer. You of course know that nothing in this podcast is to be taken as personal advice. We always recommend getting the advice of an expert in their field who takes the time to understand your personal situation. We've done our very best to ensure that the content is correct at the time of recording. Things change rapidly, so always check with the relevant government authority and your trusted advisors to get the most up-to-date information.
Today, we're talking about rentvesting, and as Veronica said, specifically how to plan properly so that it becomes a successful strategy and not a trap. We have a very special guest today, David Johnston from Property Planning Australia, who is a mortgage strategist. Welcome, David.
Thanks, Megan. Thanks, Veronica. Great to be here.
Hello, hello, hello. Look, regular listeners and students will know that we recommend having an experienced mortgage broker on your team. It is part of Module 1 in Your First Home Buyer Guide. And in fact, we have had David on the podcast, ages ago about borrowing strategy.
Episode 3 or something?
So really early on. Go back to it. We better put it in the show notes. It is actually one of our most popular episodes. It's in our top 10 episodes. You'll be happy to know. So that's why we've got you back on this one, because this is a really important topic, right? Borrowing capacity is a scarce resource and we want to make sure that you spend it wisely. And rentvesting is a strategy for some people, but not everybody. So we're going to sort of get into the meaty bits of this.
Yeah. And when you talk to a mortgage broker, David, is not just about getting the lowest interest rate for your first property. It's actually vital to talk about the big picture, your long-term goals, so that your broker can help and guide you on your own unique path to home ownership. And that's why having a long lens right from the start of the journey is so important.
Absolutely.
100%.
All right. So, David, to set the scene, we're going to do a hypothetical case study about a first-time buyer. Her name is Kath, right? And Kath is trying to decide whether she should be buying a home to live in or an investment property. And she's torn between two options. Do you want to hit the options there, Megan?
Yep. Either buy a home to live in, but she has to move away from her current location to afford it, and she absolutely loves where she lives. Or buy an investment property elsewhere and keep renting in the area she wants to live in, and then buy a home in the area she loves when her income increases. So she's on an income increasing trajectory, which is a positive thing, but can't do it yet.
Okay.
David, and I guess some of the hidden factors here.
I guess, can I just chuck in a couple extra things here before we get to the hidden factors? Because, like if Kath's single, and we do get these questions actually.
Yeah, based on a question.
Yeah. Kath's single now and she's also on a career path and she can expect to earn good money herself, but she might also couple up at some point. So there's these sort of things in the future. And this is really hard because people, when they're deciding whether they should buy now or wait, they don't even necessarily know where they're going to live. They've got all these sort of unknowns on the horizon, which might be really positive, but they also, might not actually turn out the way. Yeah, you could be paralysed in indecision because you don't actually know what's going to happen in your future. So back to Megan's question, which is, what are the hidden factors? What should she be thinking about?
Oh, look, there's a lot of unknowns at this stage of life, really. If she's single and she doesn't have a partner, things can change a lot. So I guess the lens in terms of your perspective of where you might live long term is probably a bit more blurry, if you like, because your future partner, that depending on where they're living and where their family's located, and that's obviously going to have some impact on potentially where you might live. So probably in this sort of case study with Kath, I'd be more inclined to be quite open-minded about where she may potentially live in the future, even though she does love her current location. So I'd probably be keen to unpack, what does she love about it? What are the drivers there? Are there other locations that are more affordable that she potentially could live in that would tick a lot of the boxes that she has where she's living currently? That would certainly be one of the starting points. Another key starting point is, okay, what's your entry point to get into a home where you're living now versus what can you afford, and then what is that differential? How wide is that margin? So, there's a couple areas to sort of start down the conversation and unpack, and then roll on from there.
And of course, no one actually knows what property prices are going to do either, do they? So there's all of this sort of, it's all hidden, it's all murky. So I guess someone comes to you and says, right, well, I'm a first home buyer, I haven't yet bought, I've got these options.
Yeah.
But also thinking, well, how much can I borrow now? What's the difference between what they can borrow if they buy an investment versus what they can borrow if they buy their own home? Is it significant?
Look, it really depends on the rental return you're going to get on the rental property versus the rent you're paying.
Right.
So basically, as a general rule, if the rent you're going to be getting from your investment is the same as you're paying, you'll be able to afford a little bit more on the investment property than the home.
Can I ask why? Because it almost sounds like it should be an equal equation.
Yeah, the main differentiator is the negative gearing on the investment debt. So that's the primary reason.
And we're going to talk a little bit about that because it is an important part of deciding whether to live in a home or to invest.
Yeah.
And so, I guess if you break this down a little bit further, if you think about the rent, you're generally going to be getting, if you own it yourself, you're going to be getting 100% of that rent. But often when we're single and don't know if Kath's living with anyone else or not, she's not. Okay, all right.
She's not coupled up.
No, but yeah,
She could have a flatmate.
With a friend, a flatmate or a couple flatmates to save on cash flow, that might also be a consideration. And then all of a sudden your rental expense becomes significantly lower in a like-for-like scenario. So you push up the price you're able to pay and afford on the investment property. And so, you might make some sacrifices there. And even let's say she was living by herself, but then she goes, okay, well, I'm willing to live with two friends, or maybe two people I don't know.
Or go back
to increase, well, absolutely. That's the big one. Go back home. That people will absolutely do. Even couples, see couples with kids will go back.
Do have a lot of students that do that. Yeah.
We'll go back home to really get a better price point. And, it's not uncommon to actually buy the home, but be willing to rent it out first. And then understand it might be 1, 2, or 3 years before you can move into it once your financial position adjusts enough and you build up enough of a buffer in your savings, and that, might go, okay, well, happy to live with mum and dad, the in-laws for 12 months. If you're in a couple, now Kath isn't, but so you can see here already there's a number of different sort of layers that you can work through to adjust your price point, and by compromising or making choices around your living arrangements.
That's so interesting because I guess we're at the moment, what we're talking about are these sort of short-term things to think about. We'll move on to long-term shortly. But, when you're tossing up between an investment property or a home, there are a number of things that you do need to decide what you're going to compromise on. And some of those short-term things are around the grants or incentives that might be available if it's your first home, that if you buy an investment property will no longer be available to you.
Yeah, it's a great point. And with the incentives at the moment, they're the best they've probably ever been, with, not having to pay for the miles.
If you fit in the box, they're good.
Yeah, if you fit in a certain box and you can get away with not having to pay LMI, that's a new initiative. We've never seen it ever before. It wasn't around when we were buying our first homes and properties. So it is a big one to, I guess, miss out on if you do fit in the box to be able to get that. So, you've got to look at those, what you're missing out on if you go down that rentvesting path, that's for sure.
I think that scenario is spoken about just then where you actually buy something that you're going to move into yourself. And by choosing to rentvest for a period of time, a few years, you make that affordable rather than actually go with, buying the home now with the lesser borrowing capacity, buying a lesser home that you might outgrow quicker. If you weigh all those things up, that's a really great scenario for when rent investing can be a real positive. And I think that's a really interesting way of looking at it. And I think a good broker will show you those scenarios. But then you need to go and do the Where to Buy workshop, for example, to sort of work out what your options are now versus, or if you move into it now versus if you actually have an increased borrowing capacity and can buy a better asset. And yes, you do forego some of those grants and incentives, but a lot of that depends on your cap as well. The reality is if they're forcing you to buy something that's brand new, that's really risky. Or if they're forcing you to buy something, again, that's actually not going to serve you for longer, that's all part of the equation. There's also different interest rates, though, correct, for the loan for a PPOR, a principal place of residence versus investor. Can you talk to that and what's happening there?
Yeah, so essentially you do pay, 20, 40 basis points higher, give or take, on an investment loan versus an owner-occupied loan. Also, if you're borrowing above 80%, you pay generally nowadays a higher interest rate than if you're borrowing 80% or less. So, you're also, even if so if you go down that 80%, if you fit in that box and you don't have to pay the LMI and you get the home, you're also getting a slightly better interest rate too because they deem you as borrowing 80% in that situation as well.
And they also, that's the interest rate that you pay while it's an investment is tax deductible. And so that's, that might offset that, I guess, in terms of those costs. The thing around...
after the tax deduction, the effective rate's lower than what you're paying on the owner-occupied. So, So it's an important point to make.
Yeah. But there's also capital gains tax. There's other implications down the track. One of the things, though, too, if people are looking at buying an investment property that they never expect to live in it, and let's talk about that because that often then people buy properties that the investment property is actually way smaller than they would need, for their own needs, or they can buy it in a different city, different regional area.
Yeah.
So that actually sort of opens up, and then that adds complexity as well because all of a sudden you go from, well, I really like this area, I really want to live in this area, that's really quite finite, I can really get to know that area and understand what's a good property in that area, et cetera, to, oh my God, there's 15,000 suburbs in Australia. Well, how am I going to work out? A lot to work out. How do I work out which one I should be investing in, which is a topic for another podcast. But what it does mean, though, is that people a lot of rent investors end up buying properties that are not even located in their state. So that creates problems down the track, though, doesn't it?
It does. Look, I'm probably a little risk averse and, I've been around a little while now and unfortunately seen a lot of people who've purchased. And, I'm an advocate for borderless investing as long as you make the right decisions, and there's a whole bunch of benefits to that. But if we're talking about in this situation, I've definitely seen where people have been enticed, shall we say, into buying in another state And then that property and that city has underperformed significantly relative to where they live. And there is definitely a risk we will talk about with doing that. If your long-term home, you're going to live in the city that you're currently in. And then, you're a risk to not keep pace with that market. And we know, it's a great time right now where the cycles of this capital cities are moving in different directions and different gyrations. And so again, that then gets to the point of your time frame as well for when you might buy the home, which often is too grey for people and they don't consider fully, and they're often only looking like 2 or 3 years ahead when I think you really should be looking at least 7 to 10 years ahead. Otherwise, the in and out costs and depending on when you purchased in the market cycle also can have a negative impact. So, but yeah, look, I tend to probably like the idea of trying to buy in and around the location of where you think you might live. And obviously, the more certain you are that you'd like to live long-term in that location, I think the more it makes sense to try and get a property in and around that location.
I think you make a really important point there, and that is around the asset selection, and the asset selection being not just the property itself, but the location. Because your point, and I just want to make sure that everyone really understood that, your point was that if you buy in a location that is not close to where you actually want to live in the long term, and that location doesn't perform as well in terms of capital growth during a period of time as where you want to live, then you've got a bigger gap between what your property has done and how much money it's made and how much more you've got to pay for the property that you want to live in. So the gap is actually even bigger for having taken the risk of rent vesting than if you had bought something smaller in where you want to live or around where you want to live.
Spot on. And, like an example that comes to mind of a person we'd met with where, say they bought an investment property, let's say about $600,000. Let's say the home at that point in time might have been about 900, but they're in different capital cities. And this is, actual situation variation. And then about 4 years later, their capital city, the same home is now worth 1.1, 1.2, but the asset they purchased was still worth about 600,000.
Yeah, so the opportunity cost is very, very large there.
Let's dig a bit further into that because, we'll go back to Kath, but in the meantime, I want to give you an example of a client of ours. And so they had originally owned an apartment, which you call C grade, which was in Apartment City in part of Sydney, right? And they realised that they had a property, and I think they bought off the plan from memory a long time ago. And when they owned this, they didn't have kids. They were married, but they didn't have kids. And they realised that they had actually in negative equity. I think they sold it for less than they bought it for in the end or for very close. So they realised they had a dud asset. So they decided to get out of that. They went and got some advice from a property investment house, shall we say. And
good advice?
Well, they were advised to, buy, you can buy 2 investment properties in other states, because you haven't got kids yet, you don't need your own home, you're happy living, you're happy renting, yeah, sure, you can buy 2 investment properties. So they bought one in Adelaide and one in Brisbane. And those properties, it just so happened, and they bought them around about the COVID time, 2020 and 2021. And so it just so happens that by pure luck, the investment house might argue by design, but I would argue nobody knew COVID was going to do what it did. So by pure luck, those properties did well because those entire cities did well. And I haven't benchmarked. I think one of them might have tracked, the Adelaide one probably did better than the Brisbane one. I think the Brisbane one as an asset was really shocking. Whereas the Adelaide one, it was okay. And so they'd made gains. Now, I didn't benchmark them, so I didn't really want to rub salt in the wound. They already knew that they were in trouble because, of course, their rent had gone up and up and up. And in the meantime, they had 2 kids. And they got to a point where they had another rental increase. And they were like, you know what, we don't like we now want our own home.
Yeah.
And we don't like being at the mercy of landlords and the market, the rental market. And we want security, and we want to put down roots. The kids are about to go to, one of them's about to go to school. We want a home now. So they came to us, and we sort of sat down and worked through everything, and we had them in touch with their broker. And the broker said, look, you can't borrow any more money. You can't actually borrow money to buy a home. And they're like, great. That was the whole point of buying these investments, was supposedly to build up that equity, and then we go and borrow against that, blah, 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 right? So then we looked at each of these properties, and it turned out, and we got the broker to run the sums as well. They had to sell both of them. They made gains on both of them. That's true. But they had to pay tax on those gains, and also the costs, the transaction costs of buying 2 properties, selling 2 properties, plus the capital gains tax. And when we sort of compared what their borrowing capacity for a home back in 2020 was, and what they could have bought then for that money versus what they ultimately had, 5 years later or 4 years later, after having bought these investments that had actually done okay, and in fact, you could sort of argue done better than Sydney, but the tax and the costs eroded that gain. And also Sydney had moved sufficiently that meant that they were buying less now, even though they had more money, than they could have bought in 2020. So that was actually when they had luck on their side, and the markets moved. Adelaide and Brisbane did better than Sydney over that period of time, and they still ended up being, worse off. So this is a really tricky business, isn't it?
Yeah, I think that's a great example that illustrates a lot of the pitfalls and risks and things people don't talk about. So capital gains tax, chewing up, the multiple properties. I think a big one is that people go in with the rose-coloured glasses too much. And so whoever they're sitting down with isn't actually talking them through the planning side of things enough, and the risks. And, I think, that time frame, 4 years. Too short. Like we say, you've got to be willing that this might take 7 to 10 years if you want to go down this path. And so that really gives people a pause for thought, because even in a situation like that, they go, look, we've had enough of renting, and the kids are getting a hold on. We just want to buy a house, We don't have to deal with potentially moving, all the things that we know happen, particularly once you start a family and your roots really get into a community. But the conversation, I suggest, wasn't had with them. So they're then shocked about all these outcomes. And then I think the other one is that, look, we're going to do everything, and we can talk about how we can set up your mortgage strategy to optimize the likelihood that you'll be able to keep your investment property or properties. But you should start with the expectation that you will need to sell them to get into your home.
Yeah.
And that conversation, I suggest, is probably not had either.
Also, I think the conversation about they were trying, I think they might have had the baby by the time they bought the first one. It's like that property, we call it property therapy in a way. It's like, your needs are going to change. You are going to have different pressures on you that you're not even thinking about at the moment, because all you're thinking about is changing nappies, But when you get to school age, when you get to building a community around your children, that changes.
It does.
Yeah.
And you don't know until you know it.
Yeah, I think a lot of the conversations that people have when they go to a mortgage broker are about rates. The very thing that we want people to take away from this discussion is that it is about thinking about more than just the next 6 months, more than just the next 12 months, more than just the next 2 years. And nobody's got a crystal ball to know when those babies might come along, or when you might fall in love and have a partner. But they're important things to think about. And Veronica, you've got a very classic one where you bought a 1-bedroom apartment when you didn't have a partner, and
it was actually a studio.
A studio, yeah. So, that was short-term thinking well before you were in property. You didn't know what you didn't know then.
I had no idea what I was doing.
Our students would know more than you did of that.
Absolutely.
But when we put that long lens on and we think about Okay, because I know before I was in the industry and I was having conversations with a mortgage broker or the bank as it was at the time, because my parents banked at that bank, it was not about how long do you think you'll be here, what do you think the next step might be after that. It wasn't any of those kind of conversations. It was just what's your income? Look, the rate that we can get you based on your profession is this. Like it was very narrow-minded thinking from particularly the bank's point of view. It wasn't about long-term planning. And I want to really encourage everyone that's listening to have that real think about, it's not just about getting a property. It's about what do I want this property to do for me and what sort of time frame do I need for that? And is this the right pathway or the right methodology to get me to where I want to be? If, accumulating wealth is part of that, or having a home to live in might be a different strategy again.
I think one thing I'd like to ask you, David, is that mentioned earlier, borrowing capacity is a scarce resource and it can change. So even if you start off and go, you know what, yep, rent vesting, and I reckon that down the track I'm going to be able to borrow more money, what has to go right for you to be able to borrow enough to buy a home? Because it's not like, generally speaking, people would rent vest and they would buy a smaller property than they ultimately would buy to live in. And also that means that they're using their deposit on that smaller property and on the property that's rented, which means that when they do go to buy their home, potentially they've got more equity sitting in there than they do in their own home, which from a tax planning position isn't ideal, but that's unavoidable if you go down this path. But what other things need to really go right for you to be able to borrow enough, say in another 5 or 7 years, to buy a bigger, better home for yourself in the area in which you want to live in?
Yeah, I think people tend to overestimate how positively borrowing capacity can change, and probably not just understand, equity doesn't change your borrowing capacity. Only your income.
Oh, great point.
Does.
Yeah.
And really, recognizing there are two different factors and one or the other will stop you in terms of your borrowing capacity. It's either equity and savings cap you out, or your income and cash flow caps you out. But, I always have used the analogy, like you could have $1 million in the bank, but if you don't have a job, you're not borrowing any money. And vice versa, you can earn $1 million a year, but if you don't have any money saved, you can't purchase a property either. So, try to really help people understand that. Because they can get a bit confused around why they're limited. But then, so what needs to go right? Well, I think the best thing is being great at what you do for a living. Grow your income as fast as you can. Like, that's the reality. That is the absolute reality. And so, I think the more people understand that, it probably helps them to be a bit more focused on their career, which I think generally is probably a good thing for them and probably for the country. Cut our productivity levels, but that's another conversation. But then it's really about equity. So buy a good property, get the capital growth. Obviously there are things outside of your control. We've just had all the interest rate rises. So people's borrowing capacity is significantly reduced. You can't control that, what's happening with the economy. And so things outside your control can change what you're able to do in the future. But, it's also why you need to be open-minded if you're going to rent vest, that you might have to sell the property or properties to get into the home.
Yeah.
And you get that by 7 to 10 years is so important.
Yeah. Just for new listeners, can you just explain why borrowing capacity goes down when interest rate goes up? So anyway, that's just joined us for the first time. There's lots of episodes we've done on this, but I think just if you can touch on that, be helpful.
Yeah, no problem. So basically, when you're being assessed for your borrowing capacity as a first-time buyer, they'll look at what is the interest rate you're going to pay, and then they'll be adding a 3% buffer on top of that. So essentially, if today's rate's 6%, they're working out what your borrowing capacity is at a 9% interest rate. Now, if rates come down next year by 0.5% or 1%, then it's going to come down to 8.5%, 8% in terms of the assessment rate. And so obviously, logically, the repayments will be less in terms of what they're assessing that you couldn't afford. So therefore, you can increase how much you can borrow and you can increase your purchase price.
One of the things that you said earlier, which it was great, and Megan latched onto it, which is that equity doesn't increase your borrowing capacity. So if anyone's wondering what is equity, equity is effectively the amount of the property that you owe, as opposed to you own the equity and the rest of it is what you owe the bank, right? So if you got 20% equity, for argument's sake, that's your 80% borrowing, 20% equity. And then as time goes on, where you pay down the mortgage and also when prices rise, your equity stake in that property goes up. And so that's interesting that you say that that's not, doesn't impact your borrowing capacity. And obviously equity, the other use of that word is that your savings, as in the deposit to buy a property, and then you pay that deposit, that becomes your equity. But what I guess my brain goes, oh, well, in that case, if I'm going to go and rentvest, I need to go and buy a property. I don't need to worry about capital growth. I need to worry about a property that brings me lots of income. Since the equity doesn't increase my borrowing capacity, but the income will, then I need to go and get a high yielding property and I need to buy an area and not worry about it going up in value. Now, obviously, we don't agree with that, but my brain thinking, what does a person listening to this think? And so let's disabuse that notion straight up.
Yeah, so you definitely want growth in the property value as well, because that's the money that's going towards the new home as well, which means you borrow less on the new home. So, let's say you bought round numbers $1 million investment property, your loan was 800, and then when you sell it to go into the family home, let's say it's now worth 1.5. Well, and let's say your home loans come down to 700,000. Well, now you've got $800,000 to go towards the new home versus the initial $200,000 in that scenario. So obviously capital growth is very powerful for leapfrogging into the home.
And look, that's something, but what if you don't intend to sell it? What if you're thinking, oh, great, well, I'm just going to buy something small, something cheap that I get a high rental yield on it so that then I can keep myself, flexible and free so I can borrow more money to buy my own home. Are there risks with that? What do you think? What do you think on that one?
I think that, there's absolutely a risk because you're going to have that loan. And that's why I would always say to a rentvestor, be prepared to have to sell the investment property or properties. You need to go in with that mindset because... like whatever loan, unless it becomes really strongly positively geared, it's not just neutrally geared or positively geared because of the buffer rate that we're just talking about. And because most banks, although some non-bank lenders don't have to meet the same regulations as APRA, put upon the banks by APRA. So, but the banks will factor in you're paying principal and interest, even though you're only paying interest only, maybe.
Right, yeah.
They'll add on the 3% buffer. They'll also take away, assume you're only earning 80 or 75% of the rent. So there are these big offsets that many listeners may not be aware of, that actually your rental income needs to be perhaps 50% higher than the interest you're paying before it's actually going to be that helpful to your borrowing capacity.
Oh, wow.
That takes a long time.
Yeah. So under what circumstances would you look at a first home buyer and say, okay, I think rentvesting is a good idea for you because you'll be able to retain that property?
Probably it'd be more aligned. Look, it depends on each individual. But if you're in a high paying white collar profession that you're very career oriented and focused, and say you might be a doctor, a lawyer, a engineer, or etc. Or if you're highly motivated to be a rentvestor and accumulate aggressive strategy, low living expenses, really strong focus on that, and made some very conscious decisions to be willing to put off a home for 7 to 10 years or longer. I think also the younger you are, if you're in your early 20s and you're really keen to make a real big play in property, and we know the average age of marriage now and kids is into the 30s, so there's more time on your side there as well. So those types of scenarios, you've really got to ascertain, the people, their goals,
capacity.
It's not one size fits all, is it?
No, at all.
Kath has decided to get a little bit creative, and she says to you, what about if I rent out a room or two in the property that I buy to live in? Does that give me a little bit more money? Could I possibly buy in my area of choice? What are the implications of doing that?
Look, it very well may. That's certainly what I did myself with my first purchase, which is a 2-bedroom unit in the eastern suburbs of Melbourne a long time ago. So that certainly helps significantly from a cash flow perspective, and can allow you to live in the property. But there are implications of if you're getting paid rent, then that you should be advising the tax office of that, which then can chew into there's still then some capital gains tax payable proportionately relative to the rent you're receiving. But obviously it can, and also the banks will generally not really look at your ability to rent out rooms.
Yeah,
and not factor that. So it won't necessarily increase your borrowing capacity, but it can definitely help you feeling comfortable to take on more risk to get into that home and rent out a room, rent out 2 rooms, and then as your financial position, as you get comfortable with what you're doing, ask your friend to move out.
So it doesn't necessarily improve your borrowing capacity. It does potentially help with your cash flow because you've got a little bit more money coming in. It could potentially affect your income tax and put you into a higher tax bracket if you declare that income properly. But
you might pay capital gains tax.
Might
when you sell.
Capital gains tax when you sell, whereas a home that you've not generated income from and not declared income from doesn't attract capital gains tax. When you sell it, you get the lot left over after you pay the bank out or the lender out. So Kath is being creative. We like that she's asking interesting questions.
Yeah.
But she needs to have all of this information to know whether it's a positive or a negative.
And one other area that Kath's been quite creative is she's saying, okay, well, I'm prepared to live in a different area. I'm prepared to take the plunge and, I'll research the area and all the rest of it. I'm going to go and buy somewhere that I'm not familiar with, and I'm going to reestablish all my connections, and hopefully my friends will come visit me. But if she hates the location and she wants to go back to renting, I guess then you become an accidental investor, don't you? Or you have to sell it and move again. But that's the accidental investor is a thing. Mike Mortlock has written about the accidental investor. And I guess that's an option, but I guess that's never the ideal, is it? Because you really want to live somewhere. You really want to live in your home, and then you're sort of forced to not live in your own home. Do you ever come across people that's happened to, David?
Yeah. I think it's as Mike discovered in their research, it's reasonably common. So I wouldn't advocate living in a location or a property that you don't like, necessarily. So really thinking that through further. I think often when it occurs, people have bought a house and then they've got to a position where they actually are, or they've had to move with jobs or work, or they can upgrade and they can afford to keep the first one, and they just feel it's easier to keep the first one. But that's where mortgage strategy is so important here, that you do rentvest and you want to optimize your likelihood of keeping that property, then you want to preserve the debt so you maximize your tax deductions. So in an ideal world, that's interest only, but you need to use an offset account. So you're actually not paying extra interest, but you're preserving the debt so that you haven't paid it down, or you've just paid minimum principal interest, so you've paid it down the least amount possible.
Yeah.
So that when you do come to buy the home, number one, you've got as much cash as you possibly could have saved over that period of time to go towards the new home. So you have a smaller debt on the new home, which is not deductible, but then you've kept the debt at the same level, which means your tax deductions are much higher than they otherwise would have been. And, if you can hold that property till retirement, that's going to make tens of thousands of dollars difference. It also makes a stronger financial case to keep that property when you buy the home, and just being able to keep that property and not selling it might mean an extra $1 million in your retirement.
Yeah.
Yeah.
Yeah. Because some people do also choose to buy a home to live in that they wouldn't necessarily, want to live in long term. They want to take advantage of any government incentives that there are, and then typically that might require them to live in that property for 12 months, and then they move out and become a rent investor that way. There are some tax benefits of doing that. You do get to retain your principal place of residence, standing for like 6 years. Don't take our word for it, by the way. Go and get expert advice on this. But there's things that people can do to play around with that. So that is the other way around into rent vesting versus upfront rent vesting.
100%.
Yeah,
and that's a common way that people go.
Yeah, probably. Would you say? I don't know. I mean, do we have any data on this? Is that more or less common than the other way around?
Yeah, any
thoughts?
I haven't seen any data, but I did it. My second property ended up being an investment property, but we had that advice, I think, from my parents of pay down as much debt as you can. Debt is bad. Debt is bad. Debt is bad. Pay it down. Pay it down. So it was always the intention that the property would become an investment property after 2 years. But we had listened to the wrong people and hadn't asked the right questions when we got the loan about how to set it up properly. And I think, David, I was listening to you just then and that really resonated with me. Getting that bit set up right, if you do intend to live in a property for a period of time and then turn it into an investment property, you've got to have the conversations about what good debt, bad debt is, which side of the ledger you want it on, where do you park your money if you have got commissions coming in or get an increase. And it may not be a good idea to park it on the loan to reduce the loan, but to sit in an offset where you're saving a bit of interest, but then you can, keep that debt when it becomes an investment property. Now that's a whole podcast that we have done on good debt and bad debt. So
I think we probably covered that a bit too in the episode I did with you guys earlier. It's early on.
Very much so. Yeah.
But I think, look, a lot of those themes are coming through, aren't they? And I think, for our first home buyer listeners, 80-90% of what we're talking about is strategy. It's forward planning. It's aligning your property strategy with your preferred lifestyle and goals.
Yeah.
And then, getting the right loan and product and interest rate. But don't fall into that trap of focusing on the interest rate too much. At the end of the day, my 10-year-old son knows 6% is higher than 5.9%. Okay. It's not who you should choose who you work with.
Yeah.
How you should choose who you work with. And it's also why the best strategic mortgage brokers will ask for a commitment once they've had a meeting with you. Because there's a lot of time and investment that goes into these things, and there's some real expert advice that's provided, and you don't necessarily want to give that away for free if someone's going to take your advice and then go and shop around for the lowest rate after that. So, respect the profession of whoever you're working with, because anyone who is great at what they do, doesn't matter what the profession is, they're very valuable. And so that shouldn't be taken for granted. And first home buyers, it's really good for them to understand that, because they're really new to all of this.
Yeah.
Yeah. Well, it's pretty clear that the decision around whether to rent vest or not is well, in a way, it's a short-term decision, but it really needs to be a decision around your long-term goals and how you do it. And a lot of people are making these decisions for short-term reasons, and we want to really ask you to slow down and sort of really look at that long lens. There are so many factors to consider and conversations to have with professionals like you, David, who can help you see the bigger picture and guide you through that conversation as well, because the conversation that is not about the lowest interest rates we've just been talking about, but about that big picture and how to make educated decisions to reach your goals, and not just sort of jump in to think, oh, I know, that's my solution, I need to rentvest. It's like, oh, whoa. Let's just look at a lot more than just getting onto the property ladder.
Yeah. And then make decisions, because you still have to make decisions.
You still got to make those.
You do have to make the decisions.
You can't sit in analysis paralysis and just hope that something comes your way. David, what we always ask a question of our guests, and I'd love to hear your thoughts. What is one thing that you know now that you wish that you knew when you were a first-time buyer?
I think probably just doubling and tripling down on getting into the market as early as possible. And you've got to be in it to win it. And time heals all wounds in terms of like the power of compound growth. So like I just say to any first-time buyer, like get into the market sooner rather than later. You fast track your compound growth. I think I've got some numbers somewhere, but I think over the last 30 or 40 years, property values have outstripped wage growth, by 3%. And the value of the asset is a much bigger number than your income. So if you get in $600,000 and you're growing at 3% faster than your net after-tax income, which say is $100,000, like it's a significant dollar value. You can't keep it's much harder to keep pace with the money you're making from growing the asset value of your properties. So that would be my advice. Try and get in, get informed, get educated, make a good decision, but get into the market where you're affordable, and then, where it's affordable, and try and get in again and again.
And of course, choose a good asset.
Yes, but
Always.
our caveat on that is always as long as you can choose a good asset, because even though the aggregate data shows that prices spend more time in positive territory than they do in negative, there have been people whose individual decisions have actually gone against the grain and have actually underperformed or actually returned them negative equity. And so, jumping in without doing the education, without getting good advice, without understanding all the things that we've been talking about today can actually lead you to make bad decisions. So that's why we sort of say get in once you have actually got yourself educated in a position where you're clear about what to do. 100% agree with that one.
Yeah. Obviously, asset selection and location selection. That's
We just have to spell it out in case we've got new listeners who don't know that we bang on about this all the time.
Well, it's been an absolute pleasure to have you back on, David. We won't leave it so long next time, because there's always something to talk about when it comes to long-term planning, mortgage strategy. And it is mortgage strategy. It's not just getting a mortgage. It is having a strategic approach to what you do and how you do it. Now, for our listeners, have you joined our Facebook group yet? It's called Your First Home Buyer Guide Australia, and it's your opportunity to connect with us and ask us your questions. You'll get answers from us, which means you'll be sure that you're not going to be led down the garden path.
And a quick note, you might think that we cover everything you need to know in these podcasts, but a word of warning, we don't. We're just scratching the surface here. If you really want to be an educated first home buyer, you really need to learn all of the steps, how to do everything in the right order, right? So, and that's something that the podcast, if you can listen to all 200 and we're up to 10 episodes or whatever now, trying to put it all in the right order is going to do your head in. So that's where the course comes in handy.
Yeah. Your First Home Buyer Guide only costs $990 and you get direct access to us to help guide you through your negotiations. You can also share the link of any property you're thinking of buying, and we can help you work out whether it's A, B or C grade or an absolute no-go zone. Trust me, you'll buy better and won't overpay if you do the course. $1,000, you'll pay a lot more than that if those agents get in there and push you up in price.
Absolutely.
In this episode, we've only touched on a tiny part of the huge amount of things you need to know to become an educated first home buyer. There is so much more for you to do. You can learn all of the steps in the right order and avoid all of the mistakes that others have made in our 10-step online course for first home buyers.
If you'd like to learn more about the right process and avoid making rookie errors, become an educated home buyer. Head over to the website, check out your first home buyer guide, the course that we have created for you. And don't forget to subscribe to the podcast so you won't miss an episode. And if you've liked what you've heard today, please give us an iTunes review. It helps other people find us. And of course, I know it's a bit cringy, but we're going to ask for 5 stars. Thank you.
Thanks for joining us. We hope you found this really useful. And if you have, please share the love with others who you know are in the same boat. We'll be back next week with more priceless stuff.